In today's video, I am going to reveal one of the best setups that I have used to make consistent profit in trading. The setup I am talking about here is called the First Pullback. And in this video, I'll explain how you can use it to minimize losses and increase profits for every trade that you take. So, if it is something you are interested in, kindly hit the like button, also subscribe to my channel, and turn on the notification bell to stay updated each time we make new videos. So, without further ado, let's get started. So what is the first pullback? The first pullback is a highly predictable pattern that shows up in almost every trade setup. Here's how it works. Imagine the price is in a downtrend and begins to reverse into an uptrend. As we know, it's extremely rare to see a perfect V-shaped reversal when the trend is changing. What typically happens is that the price starts to reverse, makes a brief pullback first, and then continues climbing. Now, this initial pullback after the reversal is what we call the first pullback. And I'm not exaggerating when I say this pattern is everywhere on the chart. Want proof? Let's look at a couple of examples. Take a look at this Bitcoin 4-hour chart. The price was in a downtrend and reversed upwards. It then made a slight pullback first, before continuing trending higher. Here's another chart from gold. This time, the price was initially in an uptrend. Then it began to reverse downwards, but it made a slight pullback first, before continuing downwards. You can find countless of examples like these on any chart. So try it out for yourself after watching this video. So the main concept behind this strategy is to time the first pullback and aim to enter at around the end of the pullback. The key reason for this comes down to one crucial factor: risk to reward ratio. Let's break it down with an example. Imagine spotting a setup where the price was initially in a downtrend. Then, a strong buying pressure pushes it upwards. As a trend trader, you might see that the trend is beginning to shift, and you think about entering. But buying immediately at the highs of the trend isn't the best move. Why? Because there's a chance that the price could pull back, or worse, the uptrend could fail entirely. If you enter at the highs with a tight stop loss, the pullback alone could stop you out. And if you set a wider stop loss to account for the pullback, you'll end up with a much bigger loss if the trend fails altogether. This is exactly why waiting and entering at the first pullback is almost always the better play. At a pullback, you're getting into the trade at a more favorable price, which means your stop loss can be tighter. If the price keeps dropping after the pullback, that's a signal that the uptrend is invalid. So having a tight stop loss keeps your losses small. But if the trend holds and price pushes higher, you're set to make bigger profits. Since you've entered at a lower price, it's a win-win condition. You'll get smaller losses on failed trades and much higher gains on successful ones. Now let's break down how to trade this strategy step by step. The first step of trading the strategy is knowing how to identify a trend reversal. This part is absolutely crucial. If you mess this up, the trade simp won't work. Here's how to do it. So one of the very first things traders are taught is how to spot uptrends and downtrends. If the price is making higher highs and higher lows, it's an uptrend. And if it's making lower highs and lower lows, it's a downtrend. Simple, right? But here's the thing. There's a good chance you're actually getting this wrong. Let me break it down for you with an example. Imagine a chart forming higher highs and higher lows, clearly showing uptrend, but then something interesting happens. The price starts heading down and breaks a previous low. Here's where I see most traders make mistakes. When this low is broken, many assume the trend has reversed, thinking we are now in a downtrend. But what if I told you that this chart is still fundamentally bullish? Sure, the price broke a low, but this low isn't actually a valid one. Why? Because it didn't break the valid low, which is this one. Let me make this crystal clear. For a low to be considered valid, the price needs to break the previous high after forming the low. In our example, the price never actually broke the previous high, which is this one, meaning the valid low is this one. So the price can do anything at this area, but as long as it remains above the valid low, this is still considered an uptrend. Now let's take this a step further. If the price instead moves up and breaks the previous high, this establishes a new high. In that case, the valid low shifts to the most recent low before the breakout. And for the trend to reverse, the price would now need to break this new valid low. Let's look at an example on a real chart. Here we see the price forming higher highs and higher lows, and we can identify that the valid low is this one, because it broke the previous high afterward. Later, the price moves down and breaks this valid low. This break confirms a reversal since the price closed below the valid low. Keep in mind that it's crucial to wait for a candle to actually close below the valid low for it to be considered as a reversal. Once you understand how to identify a valid reversal, we can move on to the next step, entering at the first pullback. When we want to enter at the first pullback, we need to figure out where the pullback might form. This is important because pullbacks could form anywhere on the chart, and identifying the right area is key to timing your entry. From my experience, there's a specific area where the first pullback tends to form and bounce from, and it's called the Fibonacci levels. For those unfamiliar with Fibonacci, I have a full video explaining everything about Fibonacci and how you can use it to trade profitably. You can check it out using this link I've put up here for a clearer understanding. Now back to the second step, which is figuring out where the pullback might form. To do that, you just have to wait till price starts pulling back upwards. Then you grab the Fibonacci tool and plot it from the swing high down to the swing low. Then you wait for price to give a reaction within the golden ratio, which is the 0.5 and the 0.618 levels. Keep in mind that when using this strategy, you do not want to trade pullbacks that are below or above the golden ratio. There will be times when price keeps moving without getting to the golden ratio. We will miss the trade, and that's totally fine. The key here is to only take trades that perfectly aligns with our trading plan. If it doesn't, don't force it. Just stay patient and wait for the next opportunity. As you can see, price gave a reaction at the 0.5 level, which is at the golden ratio. For further confirmation, we have to wait for a bearish engulfing candle. When that happens, it is a strong signal confirming the end of the pullback, and that's where we take a sell position. Stop loss to be placed above the 0.5 level and set the take profit at 2 times your stop loss. Letting the trade run, and you can see it was profitable. Let's look at another example. On this chart, we can see that price was making lower highs and lower lows, and we can identify that the valid high is this one, because it broke the previous low afterward. Then, the price moves up and breaks this valid high. This break confirms a reversal, since the price closed above the valid high. So next, we wait for price to start pulling back downwards. When it does, we grab the Fibonacci tool and plot it from the swing low up to the swing high. Then we wait for price to give a reaction within the golden ratio. And as you can see, price reacted at the 0.5 level. But then we need a stronger confirmation, so we wait for a candlestick pattern. And as you can see, we have a bullish engulfing candle, further confirming the end of the pullback. So we just take a buy position, put stop loss below the 0.5 level, and take profit at 2 times your stop loss. Letting the trade run, and it was profitable. Please note, the 0.618 level is also a valid level as the 0.5 level. So when price reacts from it and gives a good confirmation, you can take trades from there. If you have any question, feel free to ask me in the comments section. And don't forget to hit the like button, also subscribe to my channel, and turn on the notification bell to stay updated each time we make new videos.